The market is officially closed for the holiday weekend today on Saturday, July 4th, 2026, so we are looking back at the exact final figures from the last active trading session on Thursday, July 2nd, 2026, to understand where Ondas Holdings Inc. stands. The stock closed the session at $7.41, marking a notable downward intraday movement of 4.56% on the day, with an active trading volume that surged significantly as institutional and retail participants adjusted their exposure before the long break. While the immediate price action looks like a standard cooling-off period for a highly volatile asset, the underlying operational truth presents an angle that almost nobody is actively discussing. Most market participants checking their positions on consumer mobile applications are completely missing the fact that this company is sitting on a staggering cash reserve following their massive capital raise earlier this year. When a small-cap technology company carries a balance sheet liquidity level that approaches its total public market capitalization, traditional valuation models cease to function properly, creating a massive disconnect between negative short-term chart sentiment and long-term fiscal structural strength. This specific gap between public perception and raw balance sheet reality sets up a powerful conflict for anyone trying to navigate the asset. The general consensus across popular discussion boards is that this business is merely a speculative drone play that is highly dependent on small, slow-moving municipal pilot programs and minor corporate testing contracts. Many retail investors assume it is a dangerous cash-burning vehicle that has no business being placed alongside core foundational holdings like Apple stock, Tesla stock, or Nvidia stock, which traditionally anchor long-term growth portfolios. When people go online looking for structured investment help or setting up automated asset allocation models via systems like Schwab Intelligent Portfolios, they are routinely guided toward these massive mega-cap tech giants. However, the operational reality inside Ondas is that management is aggressively executing a comprehensive defense technology roll-up strategy, systematically purchasing entities like Cyberhawk and Omnisys to position themselves as a core provider of integrated battlefield orchestration software and critical infrastructure intelligence. They have actively shifted away from being a mere hardware manufacturer into becoming an indispensable network layer for sovereign defense forces and major Western security agencies. To comprehend why the equity has faced such severe downward pressure over the past several weeks, dropping from its recent high marks down into the current mid-$7 range, you have to look at the shifting mechanics of modern market participation. Whether individuals are executing rapid trades on the Robinhood app or analyzing long-term equity trends within the SoFi trading platform, there has been a sweeping macro rotation away from growth-oriented tech names that are not yet yielding consistent positive net income. In the current economic environment, participants using a self-investing approach or managing a basic individual brokerage account have grown deeply impatient with development-stage businesses. Even though the company recently reported an impressive top-line revenue performance of over $50 million in the opening quarter of 2026, the temporary losses associated with integrating their newly acquired business units triggered automated stop losses and panic selling among short-term traders. This coordinated exit created an artificial supply of shares that algorithmic high-frequency trading desks immediately capitalized on, driving the spot price down despite the fact that the company's confirmed multi-year contract backlog has been expanding at an unprecedented rate. Consider how you handle your own financial allocations when building out a portfolio for the future. If you routinely review your long-term capital strategy using automated platforms like a SoFi robo-advisor or research new positions by browsing popular investing sites, you know that managing risk requires looking deep past the daily noise of a stock chart. Comment below how many shares of Ondas Holdings you currently hold, or if you are choosing to sit out of the defense tech sector entirely right now. It is incredibly easy to let short-term negative price action cloud your judgment, assuming that a dropping stock price means the actual business operations are failing. But institutional analysts utilizing an advanced interactive brokers platform look at a completely different set of leading indicators. They are focusing heavily on the fact that the company secured over $30 million in verified new orders during May alone, which pushed their quarter-to-date total past the $110 million mark, supporting a full-year revenue guidance that management confidently raised to at least $390 million. That represents a massive scaling phase for an enterprise that the market treated as a tiny micro-cap experiment just a short time ago. This structural evolution becomes even more apparent when you examine the routing of retail and institutional capital through major financial institutions. For instance, long-term wealth builders reviewing their accounts through Fidelity Investments or tracking real-time industry momentum on the Fidelity mobile app have witnessed how market liquidity can temporarily dry up for smaller companies when everyone chases the same handful of artificial intelligence leaders. When trading volume shifts entirely toward megacaps, smaller equities experience wider bid-ask spreads and exaggerated daily percentage drops that do not correlate with any negative company news. If you open your personal dashboard on the Robinhood stock trading network or inspect the order flow via an interactive broker's trading desk, you can see that the implied volatility on these specific options contracts remains highly elevated. This suggests that sophisticated market makers are preparing for intense price swings as the broader investing public slowly wakes up to the immense scale of the company's defense and counter-drone contract wins across Europe and the United States. To fully understand the true value proposition here, it helps to look at exactly how the firm built its operational foundation and why its business model is fundamentally different from a typical drone startup. The company originally established its footprint by addressing critical communication vulnerabilities within heavy industrial sectors like transcontinental railroads, massive electrical utilities, and wide-ranging oil and gas fields. They designed a proprietary licensed wireless data network known as FullMax, which offers highly secure, wide-area connectivity that operates entirely independently from standard commercial cellular networks. This system is crucial for critical infrastructure operators who can't afford a single second of dropped connectivity or data interception. Recognizing that this secure communication architecture was perfect for autonomous machinery, the company strategically acquired automated drone developers like American Robotics and Aerobotics, allowing them to deploy completely autonomous drone platforms that function continuously without needing an on-site human operator, relying instead on automated weatherproof base stations that handle launching, landing, data downloading, and battery swapping completely on their own. The real inflection point for the business model occurred when management realized this exact combination of secure industrial-grade radio networks and fully automated drone fleets was uniquely suited for the rapidly growing global defense market. Through their Sentrycs division, they introduced a unique cyber-over-radio frequency counter-drone technology that can track, identify, and take full operational control of unauthorized drones, landing them safely away from protected areas by intercepting their specific command signals. This approach is completely distinct from legacy defense mechanisms that rely on physical missiles or destructive jamming waves that accidentally blind friendly communication lines. By integrating this precise cyber takeover software into the overarching command platforms of global defense primes like Lockheed Martin, the firm has effectively embedded its technology into the core fabric of modern airspace security. For anyone holding assets inside a Fidelity brokerage or executing automated strategies through SoFi Stock Solutions, this transition to high-margin defense software integration shifts the company away from unpredictable hardware sales and towards highly predictable multi-year recurring service revenues. This operational shift brings us right back to the central tension between investor expectations and structural reality that is currently playing out in the markets. The broader market expects a prolonged, complicated integration process that typically drains the resources of small tech consolidators, often forcing them to issue dilutive equity rounds that harm early buyers. The reality is that the company is backed by a monumental pro forma contract backlog of $457 million
billion and an immense cash reserve that shields it from the immediate financing risks plaguing its peers. When you analyze their balance sheet through an enterprise-grade interactive broker's account or assess their institutional backing via Fidelity Wealth Management Services, it becomes clear that the business has the financial runway to execute their long-term plan without needing to return to Wall Street for expensive capital. They can comfortably absorb their recent strategic acquisitions of Cyberhawk and Omnisys, combining automated ground robotics, stratospheric balloons, and battlefield orchestration software into a singular multi-domain operating system for allied nations. Looking out at the remaining months of the year, several distinct paths could unfold for individuals managing their capital through self-investing methods or tracking specialized tech funds via Fidelity ETFs and Fidelity mutual funds. In the most bullish scenario, the company continues to execute on its massive backlog, converting these record-breaking defense orders into recognized high-margin revenue over the next 2 quarters. As their scaled production facilities reach optimal efficiency, the initial high cash burn rate associated with their aggressive acquisition phase should drop off dramatically, proving to traditional institutional managers that the underlying business model is intensely profitable. If the company hits its $300